Hi, I'm Lindsay Biscaya. Welcome to Market Call. Jason Del Vicario is on the show today. He's portfolio manager at Hillside Wealth Management, IA Private Wealth, and we'll be taking your questions on North American and global stocks. The number to call us toll free, 1-855-326-6266, or you can send us an email to marketcall@bnnbloomberg.ca. Okay, looking festive. Jason Del Vicario, good to see you. Thanks so much for joining us.
Thanks for having me.
Let's get started. You were talking in your notes to us about your how you favor challenging economic periods. I'm not sure if you think we're in one right now, but can you elaborate on that and what you want to benefit from those challenging economic periods?
Sure. So, I mean, we are bottom-up investors. We look at businesses and not necessarily macro conditions. However, when we experience challenging macroeconomic situations such as recessions or high inflation or, let's say, spicy geopolitical situations, that typically is when we are able to buy high-quality, predictable businesses at favorable prices. And I've said this many times on this show before, when the price of a predictable, sustainable security is down, that means the forward rate of return is up. And to the extent that the long-term focused investor wishes to generate strong returns on their own invested capital, it is during these periods of time. And as you said, I'm not necessarily making a call that we're in this type of scenario, but when we are, these are typically when we have fertile hunting grounds for the situation that I just explained.
Do you think we're nearing a scenario like this, or do you not want to say whether we're actually in it or getting close to one?
Yeah, I avoid predicting the unpredictable. I think there's just so many variables that go into making any sort of forecast or prediction in terms of these types of scenarios. However, what I will say is, I mean, the way we look at it is we're always on the ready. So whether stocks are expensive, neutral, cheap, our pattern of behavior doesn't change, in that we're always sort of surveying the stocks that we have in our stable, if you will, always looking for new ones. And so, opportunity comes to the prepared mind, and that's how we tackle the way that we allocate our clients' capital.
Got it. You also say that high quality stock performance is at 1999 extremes. Do you want to elaborate? What do you mean by that?
Sure. So what I mean by that is, starting in July, we saw a very stark bifurcation in the markets. The types of businesses that we favor, again, I've mentioned this many times on the show, the way we define high quality is businesses that are founder-run, founder-owned, and have the history and ability of generating strong returns on invested capital. Those types of businesses started to trade lower or sideways through the third and fourth quarters, while businesses that may or may not be the most amazing businesses we've ever seen, history will obviously judge that. Obviously, I'm speaking to AI-related stocks, continue to trade much higher. And of course, these businesses are now large businesses and have a outsized impact on the index. That difference, that delta between quality investments and, let's say, the rest, has been the greatest since 1999. So that's what I meant in terms of quality. The performance of quality versus the rest of the market has been at a low, if you will, or the greatest difference since 1999. Again, I'm not predicting any sort of crash because, of course, we saw the tech bubble pop in 2000 and the NASDAQ dropped something like 90%. All I'm saying is, and if you look at a chart comparing the two, these trends don't typically last, and they tend to snap back in the other direction. So at some point in the future, we would expect high quality, predictable businesses as a cohort to outperform the market, which has not been the case over the last few months.
Okay, we are going to take a quick break right now. We'll be back, though, with Jason Del Vicario of Hillside Wealth Management, IA Private Wealth, taking your questions on North American and global stocks. That's coming up right after this. Welcome back to Market Call. Jason Del Vicario taking your questions today. And there's Jason joining us once again. And we're going to start with an email, this one coming in from Dennis. It reads, "Good afternoon. Can I please get Jason's opinion on Netflix? What do you think of this company right now?"
I think it's a decent company, decent to excellent company. I do think that it's expensive. I'm not exactly sure what the P ratio is at the moment. I think it's probably somewhere in around the 30s. I think obviously it's a bit cheaper than it was before they announced the Time Warner deal. But I think that this deal is kind of emblematic of one of the concerns that we have with Netflix, in that this is a business that is not asset light. They do need to spend a lot of money on content, and they need to continue to spend money on content. And I think that this deal for Warner Brothers, some $72 billion that they're having to, or at least they've proposed to lay out, is really an indication that this business is not particularly asset light. We did take a fairly hard look at it. I think in 2022, they were trading at around 16 times earnings. And maybe we're kicking ourselves a little bit because, of course, the stock went on quite a run from there. I just think that there's probably better opportunities in the technology space. The one last thing that I'll say, that it is founder-run, founder-owned. And, I do have a lot of respect for the founder of Netflix. This obviously was a major disruptor to the likes of Blockbuster and such. But I think at these valuations, it's a little bit expensive, certainly for our blood.
Okay, we're going to take a phone call now. This one, Daniel is calling in from Markham, Ontario. Hi, Daniel. What's your question?
Hi, Lindsay. Hi, Jason. My question is on Topicus. As a spinoff of Constellation Software, are there advantages of investing in Topicus? And is the AI backdrop a disruptor for companies like Topicus, or are you a long-term bull on AI tech? And also, happy holidays to Lindsay, all the BNN team, and Jason. Market call, great show. Thank you.
Thanks, Daniel. Happy holidays to you as well. Okay, so your thoughts on Topicus, and also Daniel's kind of add-on question about AI being long-term as well, long-term investment.
Sure. So as Daniel noted, Topicus was a spin-out of Constellation Software. They subsequently did another, which was Lumine. I've mentioned on the show, we've owned Constellation Software since 2014, since our inception, so over 11 years now. We took the opportunity of selling our shares of Topicus and Lumine and just redirecting the proceeds back into the mothership of Constellation Software. And we did that for a number of reasons. One, we like to keep it simple. Two, Constellation still owns large stakes in Topicus and Lumine. And three, if there were ever going to be more spinouts, and we suspect that there are, although just to be clear, the company has given no indication, that we would then benefit by owning shares in Constellation. But of course, I suppose the same could be said that perhaps Topicus or Lumine may have their own spinouts in the future. Now, that wasn't his question exactly. His question was, what are the advantages of owning Topicus versus Constellation? I should note that my kids actually own shares in Topicus. And the reason for that, of course, is one of the advantages is that Topicus trades at $120, whereas Constellation trades at $3,300. So if you don't have a lot of money and you'd like to have some invested in the Constellation software ecosystem, then the shares of Topicus are certainly more accessible. Secondly, the business is smaller. So I believe Topicus's market cap is somewhere in the 10 to 15 billion range, whereas for Constellation, it's in the 70 to 80 billion dollar range. And in theory, it is easier to grow a 10 to 15 billion dollar company than it is a 70 billion dollar company. What I mean by that is Topicus needs to, so these businesses acquire other software businesses. And so the acquisition spend for Topicus need not be as large as Constellation to move the needle. The other thing with Topicus is that they're focused in Europe, whereas Constellation has a global focus. So, they're both great businesses. As I said, Constellation owns Topicus or parts of Topicus. And we would really have no problem owning either. But as I mentioned, in terms of our behavior in the past, we sold shares of Topicus and Lumine and put the proceeds back into Constellation.
Okay.
Oh, and then AI. So,
yes. Yeah, that's right.
Yes. So shares of Constellation and Topicus and Lumine are down actually quite a bit, the most since their IPOs. And the two main concerns, and I'll talk a little bit about this later in the show, so I won't go into too much detail, was one, the surprise resignation of Mark Leonard, and two, the concern that AI was going to replace the job of software developers. As I mentioned, Topicus, Constellation, they acquire other software companies, and of course, the product of software companies is software that is developed by engineers. The thought is that AI is going to be able to not only develop software, but replace engineers. The issue, and it remains to be seen, the Constellation did a 2-hour call on this subject, and I thought they were very candid. The market didn't like it, but they basically said, we don't know. And like any new invention, whether it's electricity, the radio, television, air travel, the internet, and now AI, who the winners are going to be and how it's going to impact our lives is not necessarily obvious at the outset. So, I would say that we don't know how AI is going to affect the production and maintenance of software. What I will say is that Topicus owns a number of different companies, that the customers of these companies rely on Topicus' software for mission critical needs. And to think that these people will all of a sudden go out and replace the software that Topicus' companies produce, I think is a bit far-fetched. And it could also be to the plus side. It could allow software engineers to become more efficient. It could allow them to add features more quickly and to be able to serve their clients' needs more rapidly and more ably. So I would just simply say that I don't know. We're keeping an eye on it, but I think that the market has certainly overreacted and perhaps offered some great opportunities for people who may want to own shares in the likes of Constellation, Topicus, and Luma.
Okay, and as you say, we'll be talking about AI and software companies a little bit later. But in the meantime,
Yes.
We're going to get another question now. This one is Frank calling in from Huntsville, Ontario. Hi, Frank.
Oh, hi. Listen, my question is for TD Bank and Royal Bank. I own TD Bank and I own Royal Bank. I would like to add to my positions, but the stock price is so high, so I don't know whether to buy now or if you think there's going to be a sell-off, some sort of a correction or sell-off in the new year. And so the question is, should I buy now or wait for a sell-off in the new year? And which one would you buy, either TD or Royal Bank? Thank you. I'll hang up.
Okay, thank you. So what do you think when we're comparing TD, it's at 128, and Royal Bank, what would you say is a better bet?
So we don't own any of the Canadian banks. They have been wonderful investments for Canadians over decades. The reason that we don't own them is they are not founder-run, they're not founder-owned, so we don't necessarily like the alignment of interests with shareholders. And the returns on invested capital, while they have certainly been very consistent, are in the low double-digit range, kind of like the 12 to 15% range. And if you look at the compound rate of return of the best banks, which to or at least the most recent research I ever did on this was TD and Royal Bank. So I think, Frank, you have the top two. The long-term rate of return of these investments has been in around the 12 to 15% range. I'm looking at the charts you're putting up here, and TD Bank is up 76% in 1 year. So that, if the average rate of return over the long term is 12 to 15%, you've got, 4 or 5 years of returns in 1 year. The question really is a market timing question, and I don't pretend to have any sort of special insight as to what these shares will do in the long term. A better question, we might want to look at, or you might want to look at what the earnings ratio is. So what is the PE ratio of Royal Bank and TD? You might want to look at that in terms of its historical context. I'm just throwing this out there, but let's imagine right now that Royal Bank's PE ratio is 12 or 13, let's say, and historically it's been in the 10 to 11 range. I might suggest that you would wait for a pullback to that range, or perhaps even less than that range to add shares. Whether that happens in Q1 of next year or even in 3 years, I have no idea. You could also just take the dividends that you're receiving and simply, kind of close your eyes and plug your nose and reinvest it back into shares at whatever prices are at that time. That would also be probably just a fine strategy. So, I wouldn't get too cute, but if you want to get cute, I would look at the valuation metrics and the historical averages and make some decisions based on that.
Okay, thanks for that answer. We're going to take another quick break now, but we will be back with Jason Del Vicario of Hillside Wealth Management, IA Private Wealth, taking your questions on North American and global stocks. And here's how you can reach us. We'll be right back. Welcome back to Market Call, and Jason Del Vicario joining us once again, taking your questions. We're going to go straight to the phone lines. Robert is calling in from Montreal with a question. Hi, Robert.
Hi, Jason. Monster Energy drink for a long-term position, and is it a growth stock? Thank you.
Okay, thanks for your question. What do you think about Monster Energy drink as a long-term hold?
It is a fantastic business. the valuation keeps us away at this time. But this is a business that we like. It is on our watch list. We would need the shares to be about 50% lower for it to be in a spot where the forward rate of return exceeds our hurdle rate. It is certainly a growth business. I do believe it's been losing a bit of, so we really like winners. What I mean by that is market leaders or companies that have dominant or leading market share. Monster Beverage in some of its markets is losing share to Red Bull, and so that would be something that we would want to keep an eye on. But if you look at a 40-year chart of Monster Beverage, I don't know if there is a business on the S&P 500 that has done as well. Maybe Apple, but if I'm not mistaken, it's one of the best performing stocks over a 30, 40-year period on the entire S&P 500. So they have done a very, very good job. What I might suggest is this is an excellent company to analyze with the view of finding the next Monster Beverage. At 44 times earnings, if you do the math, they would need to grow at least 20 to 25% for you to be able to earn a 15 to 20% rate of return long term. You'd much rather find a business that has the characteristics of Monster Beverage trading at, let's say, 15 to 20 times earnings that could then see its earnings multiple expand to, say, 44, where you would get the tailwind of not only the earnings growth, but also the multiple expansion. Unfortunately, that opportunity for multiple expansion at 44 times earnings is probably in the rearview mirror. If you were to hold these shares for at least, let's say, 10, 15, 20 years, and the company is able to, let's say, increase their earnings by, say, 10% a year, you will probably wind up with a fine result, just not an exceptional result like shareholders over the past 30 years in Monster Beverage have experienced. But yes, an excellent business, just not, unfortunately, an excellent valuation or stock price at this time.
And just to reiterate before we move on for people who might have just been joining us, like that's your threshold, right? Is 15 to 20% rate of return long term for a company you might be interested in?
Yeah, I mean, also, yes, when we're looking to allocate capital, we need to do so with the view to earning a greater than 20% rate of return, meaning that the valuation of the security needs to generally be less than 20 times earnings, and that the business needs to have the opportunity, or at least a history of being able to grow their earnings by 15 to 20%. That's a very good question, by the way, Lindsay.
Okay, thanks. Yeah, no, just to clarify there for people who maybe missed the top of the show. We're going to go to an email now. This one coming in from Jeffrey, and it reads, can I get the analyst's opinion on LVMH, Moet Hennessy, Louis Vuitton, SE? It's bounced off its lows and now appears to be trading sideways, wondering if this is a good entry point. What do you think about this one?
Right. So we added, so we are typically very much buy and hold investors. So, and we take a long-term view. When we initiate a position, it is with the view of holding the shares for years, if not decades. Christian Dior, which is the holding company for Bernard Arnault's family, and its only asset is shares in LVMH. So let's just talk about LVMH here. But we own shares in LVMH through Christian Dior. The symbol is CDI on the Paris Exchange. And this was one of the four businesses that we acquired this year. LV owns 74 luxury brands across the world. It is founder-run, founder-owned, has no debt, has a tremendous history of increasing shareholder value. And of course, being founder-run, founder-owned, we are comfortable essentially partnering with Bernard Arnault and his family in that we have our interests aligned. The main brand of LVMH is Louis Vuitton. I believe it represents somewhere around 40 to 50% of the group's revenues. This is a business that is over 100 years old. While people aren't buying $5,000 to $10,000 handbags annually, our research has indicated that primarily women will typically own multiple handbags. And so we get a little bit of comfort because we really lean into companies that have a high degree of recurring revenue. This doesn't necessarily have as high as, let's say, Coca-Cola, but certainly luxury brands can continue to produce goods that are well received by the market. And they have, they have their fingers in all sorts of different luxury pies. So there's the leather goods, there's makeup through their interest in Sephora, there's fragrance, There's beverage with the Moet Chandon or Hennessy. And they also own Dom Perignon. So we feel that this company is very, very well run. While it wasn't as cheap as so we bought it it's risen 30% for us, so it's a little bit higher. I would suggest that the forward rate of return is a little bit lower, obviously, than when we acquired shares. But I think that at current levels, I want to say the P ratio is somewhere in the low 20s. For this type of group of high quality, long, sustainable assets, that the valuation is still quite reasonable. And if you look at it, I think it's probably still 30 to 40% below its all-time highs. And so, assuming that they get back to their all-time highs and then go on to make new highs, that this could represent a very good long-term hold for the long-term focused investor.
Okay, yeah, PE 28.5 to 29. We're going to move on now. Elliot is calling in from Hamilton with a question. Hi, Elliot.
Good afternoon. Please, even with the recent decline, I suspect the multiple on Costco is still quite high, and I'm rather disturbed by the last report of declining membership renewal rates. I've got a gain, but I'm thinking I might just take the money and run. What do you think? Thank you.
Okay, good question. Thank you. Yeah, what do you think about Costco and the long-term, outlook for the company?
Well, my wife and I have 4 kids. I can assure you, we have renewed our Costco membership, and we are certainly not to blame for any of the little missteps that Costco has had along the way here. Listen, Costco is an amazing business. It is one that is on our watch list. It is one that we've been watching for a long time. We'd love to own it, but as the caller mentioned, the valuation is just far too rich. But if you hold shares in Costco, and this is a great opportunity to talk about something that I think is very important. And one of my favorite quotes of all time is by Charlie Munger, who says that the number one rule of compounding is to not interrupt it unnecessarily. So Costco continues to compound shareholder wealth. They continue to open warehouses. They continue to, the Kirkland brand is massive. This is a brand that's really, they've just created, has come out of nowhere. And that has really, they've been able to essentially leverage the loyalty of their members by offering their own goods. If you want to get, I would not recommend getting cute. If you own shares in Costco, I would continue to hold them. They may go through extended periods of time. I mean, look at that from 2022 to 2024, where it went sideways. We're probably now during another period like that. Yes, the valuation is expensive, but this is an exceptional company. And I would imagine that in 10 or 20 years, you will regret selling shares, even at these lofty valuations. From our own sort of personal greedy perspective, we would hope that Costco shares could drop 50% so that the valuation would get down to a more reasonable level for us to be able to enter into a position. And mark my words, it would become a large position for us if that were to happen. But just because a company is expensive isn't necessarily a reason to sell the shares, especially if you've held it for a reasonable period of time prior to that situation presenting itself.
Okay, good to know. We are going to take another quick break. When we return, though, we'll take a look at Jason's past picks. So that's next. Stay with us. Welcome back. It's time for Jason Del Vicario's past picks. We're going to go through them now with Jason. These are from June 6th, 2025. So, Jason, we'll start with the first one. That was Kaspi. When you picked it, it was trading at $85.93 when you recommended it, and now it's sitting at $78.69. So, what do you think about this? What happened here?
Well, the stock went down 8% during the past 6 months. So Kaspi is a super app based in Kazakhstan. We've owned the shares now for about 4 years. It's certainly been a wild ride. They have a dominant market position in the space. If you think about Expedia, Amazon, PayPal, DoorDash, grocery delivery, renew your driver's license, marriage license. This app literally does it all. I wish we had this in Canada because it's really quite an amazing product. something like 70% of all Kazakhstani adults use it. They use it on average 70 times a month, so more than twice a day. It's really a ubiquitous piece of technology that has done wonders for the Kazakhstani economy. They have been encountering some macro challenges in Kazakhstan. So interest rates and inflation have been up. They do have a finance portion to their business. And they've also expanded to Turkey, which could be a massive opportunity for them, or it could be a money suck. It remains to be seen. The Turkish economy is different than Kazakhstan, but if they are able to replicate the success they've had in Kazakhstan, I think the shares trade at 7 times earnings. This is a very well-run company. We still own it. It's a small position, mainly because of the geopolitical risk and the macro risk, which has cropped up here in the last few months. But we think this is a very well-run company.
Okay, next one is Calnex Solutions, I believe on the London Stock Exchange. When you recommended it, it was sitting at £53.50, now at £46. Return down 14%, total return down 12%. Do you still like this one?
We also still own Calnex. I think it's actually not £53 or £46. It's 53 pence and 46 pence. But the math is still the same regardless. But I just thought I'd point that out. So Calnex is a business that doesn't have a lot of recurring revenues. They sell telecom equipment testing equipment, and that equipment is the demand for that equipment is lumpy. And the company has been experiencing essentially a CapEx recession for their telecom customers. To be honest, our patience is wearing a bit thin on this one. It's again another small position, again because it's small, and again because of the lack of recurring revenues. It is founder run, it is founder owned. They don't have any debt. But this CapEx recession that they're experiencing is the third in their corporate history. So this isn't unprecedented, but it has been going on for a fairly long period now, 2-3 years, and our patience is starting to wear a bit thin. So we hold it. It's let's say we've got a negative watch on it, but we do continue to hold it.
Okay, the last one, maybe not so much of a negative watch on Curves Holdings. You can see where you recommended it, where it is now, return of 15%, total return of 16%. What do you think about this one?
Yeah, so Curves is a very interesting business based in Japan. Some of the viewers may be familiar with Curves gyms, which actually started in Texas, and they were all over North America, a few decades ago, and now you don't see them anymore. Well, the reason for that is because they kind of didn't succeed in North America, but they found a home and a very willing audience of 50 to 70-year-old, predominantly women in Japan. They struggled through COVID. As you can imagine, the gyms were closed. One of the things that they did is they didn't lay anybody off. So they didn't lay their staff off. They took on a bit of debt to do this, but that has really served them well in terms of the loyalty, both from members as well as their employees. And they're now back on their front foot and growing again. It's a franchise model, which is very cash generative. It trades at, I think, around 16, 17 times earnings. So we would suggest that the shares are still very much attractive. We could see ourselves increasing our position in this company. We'd like to see more evidence of their capital allocation acumen, especially once the debt is paid off. If we get confirmation that they are going to allocate their excess capital well, once the debt is paid off, we could certainly see ourselves increasing the position. Right now, it's a 1.5% weight. We'd be comfortable taking it up to a 3% weight if those conditions, as I mentioned, are met.
Okay, we're going to take another quick break now, Jason, but we will be back. That's Jason Del Vicario of Hillside Wealth Management, IA Private Wealth, taking your questions on North American and global stocks, and we'll take more of your questions after this. Stay with us. Welcome back. Jason Del Vicario with us, still taking your questions on North American stocks. We're going to go to an email, this one coming in from Laura, and it reads, please update me on Evolution Gaming, its revenue this year, and any company developments. What are your thoughts on Evolution Gaming?
So Evolution Gaming is a top 10 position for us. It's a little over 5% of our equity weight. It's trading at around 15% below our cost. It is a founder-run, founder-owned business based in Sweden. They have dominant market share in the live online casino space, but they've encountered some issues over the past year. Namely, their revenues have essentially flatlined. They've had to ring fence some of their operations in Europe, meaning that they have had to be a lot more vigilant in terms of allowing access or disallowing access to regulated markets from unregulated markets. So you can imagine that live online gambling is legal in some jurisdictions and not legal in others. And the regulators have really come down hard on these providers of games to ensure that the people accessing the games are from regulated markets. Having said that, at 10 times earnings with nearly a 5% dividend yield, they're buying back shares. As I said, they continue to have dominant market share. And if we take a 30,000-foot view and we look at land-based casinos growing at low single digits, 2-3%, barely GDP growth, whereas online gambling is growing in the 10 to 15% range. We think that the macro backdrop, if you will, in the gambling space really favors an operator like Evolution Gaming. So we continue to hold shares. We would applaud them taking these short-term measures for long-term benefit, which really in the short term has hurt them financially, but we think it's the right move, and we continue to hold them for the long term.
Short-term pain for long-term gain, maybe, is what they say. Okay, yes. Another call. This one coming in from Jack. He's in Barrie, Ontario. Hi, Jack. What's your question?
Yes, good afternoon. My question is for BN, please. Where is it going? Because it hasn't done anything since. I don't know if because of the EP or what it is with it. Can you please tell me the price for 2026? Thank you very much, and have happy holidays.
Okay, thank you. Happy holidays to you as well. So Brookfield, what do you think is going to happen maybe in the next year or so with Brookfield? Do you like this stock?
So Brookfield is a company that we've admired from afar. We have not, unfortunately, owned shares in Brookfield. Bruce Flatt has done an amazing job with the company. They have, I believe, grown earnings by an average of just close to 20% for a long time. So this certainly is a company that would fit our criteria. Of course, I have no opinion on the short-term performance of Brookfield, but if the caller can maybe take a step back and think more long-term. I mean, it's interesting to note the 1970s, the average stock holding period was 5 years, and now we're at 10 months. If you can imagine, like if you own a business, and so we think like business owners, you're buying and selling businesses every 10 months. You're really not an investor, you're a speculator. And I'm not suggesting the caller is necessarily a speculator, but the question of what will the price be in 2026 suggests a bit of a speculative bent. So I would really encourage the caller and all of the viewers to think more long-term, because I can assure you that the managers at Brookfield and many of the other businesses are thinking in terms of years or decades, not in terms of months. So that would be my suggestion there.
Okay, next caller, Peter calling in from Vancouver with a question. Peter, what's your question?
Oh, great show. Great guest. Jason, my Vancouver hero. Your luncheon parties wish you a Merry Christmas and all the best for the new year. Okay, Jason, I'm going to ask you about Meta, but if you don't mind, can you switch it to Games Workshop? Okay, either Meta or Games Workshop.
Okay, thank you for your question, Peter. Jason, go ahead.
Thanks, Peter, and wishing you and your family all the best, as well as Peter and a number of his friends. We go for dim sum every few months, and we met right here on Market Call, and we've built a wonderful relationship over the years. So Meta is our number one position, and Games Workshop is actually our second largest position. I'm happy to speak to both. Both are excellently run businesses. Meta has a dominant position in social media. They've been able to leverage the fact that they have 3.5 billion users. I mean, if you think about the reach I don't know if there's another business on the planet or in the history of the planet that has been able to reach that many customers. And I put customers in quotations because, of course, people on WhatsApp or Instagram or Facebook don't necessarily pay to be on those networks. And that's also part of the beauty of the network effect of Meta. Games Workshop is another really, really interesting business. Our number 2 holding, they're the British-based tabletop games company. This is a really interesting company that is able to grow without using a lot of capital, so they're asset light, pay a very nice dividend. I will say that both Meta and Games Workshop are, sort of at the upper ranges in terms of valuations in the high 20s, low 30s. So if you don't own shares, these are fabulous businesses, but you may wait for a better opportunity, as in lower valuation, for which to be able to add those shares.
Okay, good to know. We are going to take another break just right now, but we're going to be back with Jason Del Vicario of Hillside Wealth Management, IA Private Wealth, taking your questions on North American and global stocks right after this. Stay with us. Hi there, welcome back to Market Call. We're going to go straight to the phone lines. Mitch is calling in from Brampton, Ontario with a question. Hi, Mitch.
Hi there. Thank you for taking my call. I wanted to take Jason's opinion on D&D, which is Durham, with a possible takeover on the table. Thank you.
Okay, thanks for your question. Durham, what do you think about this?
That chart kind of says it all. This has been an example on how not to manage a company. I'm looking at them here. They have a consistently negative returns on invested capital. I'm not exactly sure where this company went wrong, because whenever I've gone to do anything at a legal office, whether it's conveyancing or the likes, there's always a technology fee, and it's always kind of annoying and high. And this is really the types of businesses that Durham was rolling up, which is technology companies in the legal space. So for them to have destroyed shareholder capital to the extent that they have, I'm imagining that the incentives were wrong, and that the people that were running the business were really incented to do the wrong things, which is probably to just grow the top line without paying too much attention to the bottom line, and or take on too much debt. So, whether there's a bounce here after a 77 or a 90% drop, I have no idea. Again, coming back to what I was saying earlier, I think people should be allocating capital with the view of, let's say the market closes tomorrow for 5 years or 10 years. Would you be okay owning shares in Durham in 5 years or 10 years if the market closed tomorrow? I would suggest probably not. But if you think through that lens, I think you'll make much better capital allocation decisions for yourself and your family.
Okay, interesting way to look at that. We're going to go to another phone call, this one coming in from Edmonton. JP is asking the question. Hi, JP.
Hi, I was curious on both your thoughts on Oracle. I know that there's been some concerns with their cloud-based spending and data spending and some ROI issues. So curious your thoughts on that, and wanted to wish the both of you happy holiday season. Thanks.
Thank you. Happy holidays to you. Okay, we're talking software companies quite a bit today. What do you think about Oracle?
Yeah, so if you look at a very long-term chart of Oracle, they skyrocketed up into the tech bubble in 2000, and I think then it was about a 15-year period before they took out those 2000 highs, and it kind of feels like we may be having a repeat of that type of experience here. The shares are fairly expensive. They've certainly been caught up in the AI hype, if we want to call it that. Their traditional franchise business is still strong. They still are founder-run, founder-owned, which of course we like. But we think that there's better opportunities in the software space. I can't provide too much more insight than that, because this isn't one that we follow very closely.
Okay, we'll move on then to an email, this one coming in from Sly. And this email reads, what is your opinion on Microsoft? Jason, what do you think?
So my opinion on Microsoft would be similar to Monster Beverage and Costco. Amazing business, not as expensive as Monster Beverage or Costco, trading at around 35 times earnings, but really a very, very strong business. They are no longer founder-run, founder-owned. And if you look at the shareholdings of their management team and board in relation to, and I know they're a, whatever it is, $3 trillion company, and so it's probably a little bit silly for us to expect them to have a large a percentage of the shares outstanding, but really their shareholdings as a percentage of the shares outstanding is quite low. The return on invested capital in Microsoft has started to trend down a little bit. It is one of our largest positions. We do have about a 5% weight in them. We've held them since, I believe, 2014. Again, coming back to my Charlie Munger quote, number one rule of compounding, don't interrupt it unnecessarily. So if you own shares in Microsoft, I would continue to hold them. That's what we're doing. And if you don't own shares in Microsoft, I would suggest that you would want them at least 20 to 30, maybe even 40% lower in the low 20 P ratio range to be able to initiate a position. But, fabulous company. They've done a tremendous job of increasing shareholder value over the long term.
Okay, Jason, thanks for that. Now we're going to take a quick break. When we return, we'll take a look at Jason's new top picks. That's right after this. Join us tomorrow on Market Call. Paul Harris will be on the show. He's portfolio manager at Harris Douglas Asset Management, and we'll be taking your questions on North American and global stocks. And if you missed Market Call, you can always check out our daily podcast. You can find it on iHeartRadio and other platforms, and you can also watch full episodes on our YouTube channel. And time now for our top picks. Jason Del Vicario joining us once again. So, Jason, we'll go through these. The first pick is Novo Nordisk, your newest holding.
Yes. It's interesting because the stock is actually up quite a bit today, although I had it as a top pick before the move. And if we look at a longer term lens, it's down actually quite a bit from its all-time highs. Novo Nordisk is a over 100-year-old company based in Denmark. Actually has ties to Canada because insulin was first discovered in Canada, and then the very original founders of Novo took it back to Denmark and made it into the life-saving drug that it is today. But Novo Nordisk has really, I shouldn't say pivoted, but they've added weight loss drugs, most commonly known as Ozempic and Wegovy, to their stable. And they have market-leading positions in both insulin and diabetes care as well as weight loss market. Although recently they've encountered some very, very stiff competition from US-based Eli Lilly, which has led to their stock cratering. I think Eli Lilly trades at around 50 times earnings, with Novo Nordisk trading at 14 times earnings. We think that Novo Nordisk has been unfairly punished due to the competitive threats. What's interesting with Novo Nordisk is that they're not founder-run, founder-owned. They're actually owned by the largest foundation in the world, which is the Novo Nordisk Foundation. And this foundation has really stepped in, flexed their muscles, not happy with the recent challenges that they've faced. They've replaced the CEO, they've replaced the board, and there's a huge amount of white space in front of them. Obesity affects somewhere in the neighborhood of 1 billion people worldwide, and somewhere in the neighborhood of only 50 million people are actually receiving these drugs, which are incredibly effective. And so we think that Novo Nordisk and Eli Lilly can continue with their duopoly and continue to grow the market and grow together.
Yes, and obviously Novo Nordisk up today more than 9%. I think I just checked because of that weight loss pill, that news. But I take your point that there's a lot of room in that market for a couple of competitors. We have to move on. Your next pick, we talked about this earlier when it comes to software companies, but now we can talk specifically about Constellation Software. What do you like about Constellation Software?
We like a lot of things about Constellation Software. So they are founder-owned, although they are not founder-run anymore. Mark Leonard, the founder of Constellation Software, recently, a few months ago, resigned due to health reasons. Mark Miller, who is the head of the very first company that they acquired over 30 years ago, is now the CEO of the business. If there was any business that would be able to withstand the resignation of, or the stepping back of, a founder of the ilk of Mark Leonard, it is Constellation Software. They are famously decentralized, meaning that they allow the businesses that they acquire under the certain parameters. So they acquire a business, they provide them sort of best practices. This is the Constellation way. And then they let them continue to run their business, run their product with the assumption that they know their customers best. So they have 2,000 businesses that they've acquired. These are all running independently. The people running these businesses have the ability to, they themselves in turn, deploy capital. And the company has been able to deploy capital at high rates of return and being able to do this as they scale, which is incredibly difficult to do. And so I would say that that is one of the risks of Constellation is, are they going to be able to continue to deploy capital at these high rates of returns? Because of course, as the company gets bigger, that becomes increasingly more difficult to do so. Having said that, we could have been having the exact same conversation. In fact, we did have the exact same conversation in 2014 when I first highlighted them as a top pick. They were $250 then. You know, they were whatever it was, a $5 billion company. They're a $70 billion company today. And so they have been able to effectively scale well. And we believe that they'll be able to continue to do that for the foreseeable future. Maybe not the same 20 to 30% rate of return long term, but they will still be able to do well.
We have about 1 minute left for your last pick, and that's Plover Bay Technologies. So I'll let you take it away.
Sure. So Plover Bay is a Hong Kong-based company. They are one of the rare businesses that is able to grow without requiring too much capital. So they are really the holy grail of companies, which is that they are an asset-light compounder. And they provide unbreakable connectivity in a world where we are demanding ever-increasing amounts of data. And we want that data now, and we want it always. Plover Bay produces hardware and software solutions that is used in things like cruise ships, mining operations, events, even shuttle buses in Silicon Valley. We've held shares now for 5 years. They've done very well for us. At 20 times earnings, they're not cheap anymore, but they're also not expensive. And we will continue to hold the shares for the long term and feel like this is a very strong company.
Okay, that's all the time we have. Jason, thanks so much for joining us. Appreciate it. Appreciate your hat. Happy holidays. Thanks so much.
Happy holidays, everybody. Take care. Bye-bye.
Bye. And thanks for watching Market Call today. We will see you next time.